G'day again, Year 12, and welcome to another YouTube lesson. Today we're going to take a look at the first content lesson of financial management. Last lesson we took a look at the syllabus, going through all the students learn to, especially the students learn about. In previous YouTube clips, we've been taking a look at human resources. Now, this is the first subtopic in the finance business function. And this subtopic will take a look at the role of financial management, the job there, financial management. Just a quick recap though, because it's important to try and make sure you remember how this syllabus works, how it all fits into place, because it actually is pretty easy. It's a little bit repetitive, but that's good in a way in terms of being able to recall all that information. So we have the role of finance, or the role of HR, role of operations. Then whatever business function it is, we're doing finance, you have the influences of finance, the influences of marketing and so on. Then we take a look at the processes, a set of steps involved in finance, marketing, whatever. Then we take a look at the last part of the business function, which would be the strategies. Strategies that can be used in terms of finance, HR, and so on. The only one that's a bit weird, because they wouldn't want to make the syllabus make perfect sense, that would be sensible, but they've used the effectiveness of human resources, the effectiveness indicators. And these are ways to evaluate whether a business is good or bad in terms of HR. Don't get me wrong, it's a good thing. I just think they should have done that for each of the different business functions. But I don't worry too much, because if we take a look at the rest of these syllabuses, such as finance, we can find other aspects that can be used as a criteria, a way to measure and evaluate how good or bad a business is. For finance, it's the objectives of financial management, which we'll take a look at today. Like if they've got great profitability or good levels of liquidity, then you can say a business is traveling well. Okay, let's get into it. The role of financial management. It's about the planning and monitoring of a business's financial resources to enable the business to achieve its financial goals, such as profitability, growth, etc., etc. Those 5 that I mentioned earlier. In essence, this is what is the role or the job of financial managers, what they're there to do, i.e. they're there to look after the finances of the business and to make sure they're meeting their key objectives. Now, there's 3 parts of the role of financial management we need to get and understand, or you need to get and understand. I get paid 115 grand plus on costs either way. But the first one is the strategic role of financial management. The second part of this role of financial management are the objectives of financial management. And the last part of the role of financial management is the interdependence of finance with other key business functions. That might sound familiar, and it should, because we've already done that when we were looking at human resources. And it's part of every single role of marketing, of HR, all of them, because they're interdependent with each other. Kind of makes sense. Now, what's the strategic role of financial management? It's the long-term job of financial management. Okay, and some of these roles include setting financial objectives and ensuring the business is able to achieve these goals. Sourcing finance would be another strategic role of finance. Preparing budgets, forecasting future finances, preparing financial statements, maintaining sufficient cash flow, and distributing funds to other parts of the business. These are all seen as key financial objectives, key strategic financial objectives. All right. Now, in terms of the objectives of financial management, there's how many? Test yourself. See if you've been reading the syllabus, paying attention. If you said 4, you'd be wrong. There's 5. What are those 5? Again, let's have a bit of a quick quiz and see. Profitability. It's the next one. Doesn't have to be in any particular order. Growth, efficiency, liquidity, and finally, remember the last one? Solvency. These are the ways we can see if a business is good financially or crappy financially. Okay, and a business, if it wants to be financially stable, need to try and meet all or most of these objectives. And you can't often meet all of them at once. You want to try and focus on the key ones, part of the strategic role, and try and achieve those key objectives that your business might be focusing on. And it's different from business to business. Now, the first objective is profitability. This is the objective that focuses on how well a business is faring in relation to its profits. There are three ways to see if a business is profitable. That's through the gross profit ratio, through the net profit ratio, and through the ROOE, return on owner's equity. Now, when we go to the gross profit ratio, to find that out, you're given the ratios now. It's a bit silly. It's pretty easy. I would like you guys to actually try and remember it yourself so it makes more sense. You're not just copying something. Gross profit ratio equals gross profit divided by sales. That's what the syllabus says. But I always want you to put in percent, so times that by 100. Gross profit ratio equals gross profit divided by sales times 100. Now, the net profit ratio, what might that be? I'm pretty sure you can figure it out. If you said net profit divided by sales times 100, you'd be correct. Okay, it's always going to be less than the gross profit because there's all those other additional expenses that you see on your income statement. Now, the last way to measure profitability is the return on owner's equity. I think it's the best measure really of profitability. It's net profit divided by total owner's equity divided by, net profit divided by total owner's equity, again times the 100 to get a percent. And ROE looks at how much return owners receive from their investments. All right, now the next financial objective we have is growth. This objective looks at the business achieving growth, either through increased sales or increasing the business market share, and so on. Often this is a key business objective, key financial objective in the establishment phase. Remember the business life cycle, the establishment phase and the growth stages, even ahead of profit. You want to grow your business, you're happy to maybe make a loss. I don't know if happy is the right term, but you're willing to make a loss in the short term. So in the long term, you can then recoup the cost and generate profit. You want to grow that business at the start. Now, the next financial objective we have is efficiency. This looks at reducing waste, so making things as cheap as possible. And also it's about doing things as quickly as possible, as we'll see with the accounts receivable turnover ratio. Now, there's two ratios to measure efficiency for a business. The first of these ratio is the expense ratio. Not surprisingly, the expense ratio looks at expenses. Okay, now to find out the expense ratio, you look at total expenses divided by sales. Again, I always want to see it as a percent, so you times it by that 100 to get your percent. Now, this is the opposite to net profit or gross profit ratio. You want those to be high. With the expense ratio, you want expenses to be low. So you want that percentage to be 8%, 12%. Might be 50, but as low as it can be. Now, the second way to be able to measure, to be able to evaluate if a business is efficient or not, is the time it takes to do things. In particular, to collect a business's accounts receivable. So this is the only sort of real weird one with the ratios. It only gives you half of the formula to find the ratio. It makes sense, but it is tricky. If you're not getting it on this clip, come and see me in person, read the textbook, read my notes and my examples I've got in my notes, and it might make a bit more sense. It's hard to explain it on YouTube like this. So the accounts receivable turnover ratio is the sales divided by the accounts receivable. Sales you'd see on your income statement, accounts receivable you'll see on your balance sheet. Okay, and so you go sales divided by accounts receivable. This gives you a number. So that number's 10. What that number means, which it doesn't say so much in the textbooks, is that's the number of times a business on average collects their accounts receivable. The money the clients owe them. If it says 2 with the formula of sales minus accounts receivable, number 2 pops up. That means they collect within a year the accounts receivable from their businesses twice. That's not very good. That's a long time between drinks, as we say, between getting your accounts receivable, their accounts payable. It says 1, Jesus, you're getting it once a year. Sorry for religious people. You're getting it once a year. That's not so good. Now, that's the formula they give you. We want to figure out how many days on average it takes for you to get paid, your accounts receivable paid. If it said 1, that accounts receivable turnover ratio, you do the days in a year, which is 365. You divide it by the amount from step 1. So if it was 1, that means that it's taking you 365 days a year to get your accounts paid. Not good for any business. If it said 10, that's better. You're collecting your accounts receivable on average 10 times a year. So 365 divided by 10 means 36.5 days on average it's taking to get your accounts receivable paid. So it's about speed. The less days, the better. The less days, the better. Okay. Now, next measure of the objectives is liquidity. This refers to the business's ability to meet their current liabilities. Whether a business has enough current assets on the balance sheet to pay their current debts or liabilities if they fall due. The ratio used to assess a business's liquidity position is called the current ratio, or it's called the liquidity ratio because it's about liquidity, or because why not have 3 names for the same thing? It can be called the working capital ratio, and it is current assets divided by current liabilities. No times it by 100. Why? It's just you don't. And all the tests I see, we don't do that. Now, the higher the number, the better. Say 2 to 1 means $2 of current assets for $1 of current liability. That's good. If you're getting it too high, it might sound good, but you've got a lot of money just sitting probably in cash or in your accounts receivable that could be used elsewhere. It's maybe not the best. But 2 to 1 is good. 3 to 1 better. 5 to 1, maybe not so good. Maybe too high. Now, solvency is the next objective a business wants to be able to achieve. This objective looks at a business being able to meet its financial commitments in the long term, whereas liquidity is the short term. Short, long. I.e., does the business have enough equity compared to debt? You want more equity, less debt. That makes you more solvent, less likely to become bankrupt. Now, there's a ratio again for solvency. Always a ratio. Now, they give you the ratio again because you're lazy, and they probably shouldn't, because then you'd have to do some study, but they give you one. It's total debts or liabilities divided by total owner's equity. And again, that's what the syllabus says, but I want you to times it by 100 to get a percent. Now, the lower the ratio, the better. Okay, this is because it's debt divided by equity times 100. If you have less debt compared to equity, that percentage is going to be lower. You don't want it to be too high. If it is 300%, that means you have $3 of debt for $1 of equity. Jesus. You know, you should start sweating if you're a business manager if that gets too high. Bigger businesses can probably carry more debt compared to equity, okay, but it's not recommended to make it too big. If it's way too low, that can be a problem too, because you should take out some more loans to be able to better grow and expand your business. You know, it's like called a lazy asset. You're wasting your opportunities, I guess. Now, there's this notion in the syllabus called short-term versus long-term. Short-term financial objectives of business are called operational, short-term, okay? Whereas, as I said before, long-term is strategic. Now, you've got all these 5 financial objectives. You can't achieve all of them at the same time, and you have to weigh up which short-term ones you want to achieve compared to which long-term objectives. There's a little example that I give with Virgin Australia, you know, the plane. Hopefully not blow up, that'd be bad. And when they first came into the Australian market, they really didn't worry about profit as an objective. They cared more about the growth objective. So growth in the short term for them meant profit in the long term. They grew as they entered the market. They used a pricing penetration strategy. They really sold flights sometimes below cost to be able to be recognised as a brand against Qantas at the time, undercut Qantas, get customers, and then they've increased their prices to be able to make a generous profit. Still seen as a budget airline compared to Qantas, but that was worrying about growth at the expense of profitability. The other thing is, short term is liquidity, and long term, it's not liquidity, we're talking about solvency. So that's some things you need to be aware of with short and long term objectives of a business. We're almost there, thank God. Okay, the last dot point in the role of financial management is interdependence with other key business functions. Now, how many functions are there again? If you don't know how many there are now, that's a serious problem. If you don't care, well, there's some concerns. There are 4 business functions. This syllabus dot point requires you to be able to think about how does finance rely upon, need and vice versa, work with HR or marketing or operations. How are they interwoven together? How do they work together and rely upon each other? Need to coexist. I'll give you some examples. Finance and HR. Finance must pay workers in HR and marketing their wages. So that's finance being interdependent with marketing and with HR. Okay, without marketing, which includes human resources workers, same with operations, then they're not going to be able to employ workers. As far as I'm aware, these days, marketing's not really done by capital, by machines, that much. It's getting there. It's mainly labor intensive. And hence, without finance, the business would grind to a halt. Wouldn't have the campaigns, the promotion, okay, and so on to be able to generate sales. But, as you just heard me say, generate sales. Marketing, HR, operations, they all allow products to be made in the case of operations, to be able to be sold, to be able to be marketed, so that sales occur, profit is made, and they all assist and help finance. All right, in every single way, every business function has a budget and requires financial payment, financial help to be able to operate. But all of these business functions in some way value add and generate income for finance. Unpopular, someone sending a text, probably my mum. Okay, so can you see that interdependence with the other business functions? You need to be able to give some examples, and that may well be likely to be a short answer question. Okay, guys, see you in class and look forward to you listening to the other YouTube lessons. Thanks.